Welcome to Back to Making Money Matter, ladies and gentlemen. I'm your host, Kerry Stevenson. And by the way, before I get started with the wonderful David Hunter, if you like the content on the channel, could you please hit subscribe? It helps me to get wonderful guests like Mr. Hunter, who is very busy. And you all came back to me and said, get him back on. And I did say last time it would be December. Well, it got into the silly season. And look, it's January. I know it's mid-January, but he's back. We're going to talk about what's happening in 2025. But please, if you like the content, hit subscribe, hit like, share it with others, because that way we can continue to bring fantastic content to you and help unravel what I see is a fairly complex and confusing time for many. But let's welcome back David Hunter. He is the Chief Macro Strategist for Contrarian Macro Advisors. He's been on the channel. The last time we spoke was late September, where David was calling for a melt up before a deflationary bust. So David, thank you so much for your time again. A lot of people said to me, where's David? It's December. Well, think of us, ladies and gentlemen. It's mid-January. It's okay. Don't freak out. Welcome back.
Thank you, Kerry. Great to be back. Yeah, it's probably best we wait until January anyway. December was kind of a bust, at least the second half.
Talk to us about the bust in the second half. What do you mean by bust? I mean,
I just mean the end of December. We usually get our traditional year-end rally, in the last half of December. Really, we kind of limped into the year-end, so not much happened. I'm kidding about it being a bust, but we basically saw the all-time highs in the U.S. markets in the first half of December, and we've been correcting ever since. So,
when we last spoke at the end of September, you made some fairly bullish calls on the Russell, on the S&P, and various other indices out there about how, right now you could lose out on, I think you said 30 to 40% gains before the bust. What's it looking like now? Because we're now in 2025. I think you said the bust would be second half of 25 or perhaps into 26. I'd love that big picture, and then we can drill down into some more detail.
Yeah, the equity markets in the U.S. had a pretty good period up into the election and just beyond. Trump's election, that week he got elected, the market was up 5%. They like his policies, they like what they see, and we went to those new highs in early December. The Russell, I think, touched its old high or got up close to it, and the S&P and Nasdaq and Dow went little, another week or two beyond that and made their highs. But we're nowhere near the top yet. We've been spending the last 3 weeks correcting. I think there's a good chance the correction is not yet done, but I would guess within the next week it might be done. And it's not a lot of downside. The S&P finished today just over 5,900. I think you could, fall a little over 100 points from here is all I see from here. So if we get down to, there's a gap at 57.90. If we get down and fill that gap, that's basically a little over 5% pullback. The Nasdaq could probably get down to maybe 18,400, 18,450, and that's probably a 7 or 8% pullback from the all-time highs. So I think it's a pause that refreshes. You are seeing, it's funny, we had, as we came into the end of the year, when Wall Street does all their annual projections for the next year, people are posting on X to me, they're starting to sound like you. Aren't you getting nervous that now all of a sudden you got everybody agreeing with you? And I said, well, first of all, I predicted 2 years ago, 2.5 years ago, when we were at 3,500 in the S&P, I said, once we get near the highs, I'll sound like everybody else, because that's how psychology works. They'll be bullish when we get up closer. So that's beginning to happen. But as I say, the highest, I think the highest estimate for 2025, and as a year-end number, I don't do year ends, but when Wall Street puts out a number for the next year, it's a year end, for year end 2025. I think the highest number I've seen is 7,100. I'm at 7,500. So
Wow.
that's pretty, they're getting closer. But most of the street, I think, is looking for, 65 or 6,600, maybe 67. Um, and frankly, as I say, they're there because of the momentum of the tape. It's the psychology that they fought it for 2 years. They kept saying valuations are high. This thing's got to roll over. They didn't believe we were going to see new highs. And when we pushed through 4,800, they said, yeah, but it still looks high risk up here. And it's only been once we pushed above or got close to 6,000 that they started raising their numbers and jumping on board. But they're on board because of the momentum. So they're really not high conviction. I think all you need is a sell off of 5% on the S&P, and a lot of them will turn tail. They'll start hedging their number, or they'll be calling for 20% pullback, or and I'm starting to see topping calls, particularly from technicians saying that the market may have already topped and that we have big downside ahead, crash ahead. So I think you are just with the little pullback we've had for a few weeks, you are seeing people get nervous. By the way, we are getting, I think, a lot of analysts on the street talking about the narrow breadth. They're saying we're back to where the equivalent of the Magnificent Seven are propping the market up, propping the indexes up, but below that, there's not much. That most of the stocks are going down.
Yeah.
And that's true in a snapshot. But the problem is they have to step back and realize that in the last couple of months, because of a very negative bond market, you saw the small caps had made a major run, and now you've seen them slip away because rates are much higher than they were a couple months ago. You're seeing the value stocks that made a run this summer and into the fall slipping away because interest rates are moving up, etc. I view that as all part of a corrective process, not a sign of a top. So they're right that when we move towards the top, oftentimes the market narrows into the top. So
Right.
when you don't have breadth, you don't have a quality rally. It's just a narrow group of stocks leading the way. That's usually dangerous. I don't think that's the case here. I think it's really a case where you have to look at the situation and realize we've had a tremendous backup in rates. I don't think it's going to last much longer. It's based on, to me, a couple false premises. And so if I'm right, if the bond market's going to roll back over and rates are going to head lower again, you'll see the Russell back in leadership. You'll see the breadth broaden out. I have been saying this for a while. I think what makes this cycle unusual is that into the top, you'll actually have a broad rally rather than narrowing of a rally. You'll have a broadening. And that's because I think the bond market will be moving up again. Rates will be moving down. Part of the backup in rates.
Sorry to interrupt you.
Yeah, that's okay.
There's a lot to take in there.
Yeah, I'm jumping around.
Are you saying that rates will lower before they start to really increase substantially over time?
Yeah, we are still, in my opinion, we had just to kind of give some perspective. We had 5% 10-year, a little over a year ago, back in October 23, I think.
5% so 10-year, yep.
From 5%, the 10-year went down to 360 I think in September of this year. Mm-hmm. And since then, we've backed up to where we're at 470 today. So we backed up 110 basis points. Okay. We haven't gone back all the way back to 5, but that's a huge backup in rates. And what you've got is a lot of people thinking that, and it's come with a narrative of the economy is showing more resilience, more strength, and inflation's ticking up. So they're starting to think the Fed's done for a while, if not at all completely. But certainly, you're not going to see the kind of rate cuts that were anticipated a few months ago. And they're starting to believe that maybe, the stock market's topping out, et cetera. So what I'm saying is, I don't think that's what's going on. I talked about false premise before. I think a lot of the backup in rates happened when Trump got elected. There's a narrative out there, and a lot of analysts, both in the government and on the street, do static analysis when you're talking tax cuts. They look at marginal tax cut rates as cuts in revenues. They view it as, well, if you're cutting the rates, you're not going to generate as much revenue. Under supply side theories, you cut rates, you grow the economy, and in the end, you get more revenue. I use the argument or the analogy of, if a department store needs to boost sales, they put things on sale, they cut prices.
Yeah.
And in so doing, they generate more revenue because they get a lot more interest, a lot more buying. So it's kind of the same thing where you're providing incentives by cutting tax rates, marginal tax rates. You're providing incentives to consumers, to businesses, et cetera, to spend, both capital spending, consumer spending, et cetera. And in the end, the economy grows faster and you end up with higher revenues. And that's not just a theory. That happened under Reagan. That happened under Trump's first tax cuts. The problem was pandemic short-circuited it, so it didn't happen very long there. And number two, everybody points to the deficits. Well, the deficit is two things. Or the government's debt. It's two things. It's your revenues and your spending. Our problem is not that we aren't growing revenues when we cut taxes. Our problem is that at the same time we're cutting taxes, we're spending a lot more. And so our problem is a spending problem. If the spending were flat, we would have had a shrinking deficit because tax revenues rose. So going forward with Trump's policies proposing more tax cuts, and among other things, deregulation, et cetera, I think it's safe to assume that his overall pro-capitalist policies are going to grow the economy and are going to produce more revenue, not less revenue with the tax cuts. And so, but because most analysts that do that, study the taxes, are always using a static model. They come up with, okay, you cut tax rates, cut tax revenues. And so they're very bearish on his policy. They think his policy is going to increase deficits and cause more inflation, as tariffs, et cetera. And I would argue quite the opposite. So I think that's a false narrative that's out there. A big part of the reason rates have backed up is that false narrative that Trump's policies are more inflationary. Trump's policies are going to cause bigger deficits. And I think they're wrong on both counts. Number two, the second narrative that is driving rates higher is this idea that, the economy's picking up speed again and inflation's starting to tick up. So, there's a lot of bears out there thinking, we've gotten as low as we're going to get on inflation. And so, you can't go further with rates. Fed can't cut further, et cetera. I disagree with all of that. I think the economy is going to slow. Certainly this backup in rates, 110 basis point backup in rates has also backed up mortgage rates, has backed up lending rates, et cetera. You're bound to see, and I think it'll start in the first quarter, a slowing in housing, a slowing in auto sales, a slowing in capital spending, et cetera, because you've just increased the cost of borrowing by quite a bit. And so that, I don't think this narrative of a stronger economy going forward is going to last very long at all. And once the realization sets in that, yeah, we're not in a strong economy, it's still trending down. And if inflation follows that, you're going to see bond markets go on a tear.
And you can see rates will be cut in that scenario. Am I correct there?
Yeah, I mean, my forecast is still that I think in 2025, probably and again, the timing's a little bit guesswork, but in the first half of 25, I would not be surprised to see the 10-year, which is currently 470 and might go to 480 before it rolls over. I would not be surprised to see that down near 3% the first half of this year, and maybe down as low as 2.5%. In the second half of the year, when I think a global bust is likely, and then maybe third quarter, maybe fourth quarter, but sometime out there, I think rates will go another leg down to. I think the 10-year could get to zero in the global bust, because I think the bust is going to be a global deflationary bust. Again, global, not just U.S. And I think bust, to me, when I use the term bust, I'm stating that it's something worse than 2008-9.
Shit.
So if we get that, I think it's going to push rates. It's going to push inflation into deflation and rates to zero. And the way you get to zero 10-year or zero rates is that when I say global bust, that means a banking crisis around the world. You're going to see bank failures around the world. And just like
David, sorry to interrupt. On what's the catalyst that causes something that you just said could be worse than 0809? And it's kind of, since we last spoke, David, I'm almost paralyzed. It's a paralysis of overanalysis, if you like, because I don't know whether I'm going left or right. So I'm sitting here thinking, do nothing.
Yeah, I want to back up at some point and make sure it's clear, because this is a very schizophrenic forecast, because it's
correct.
Big ups and big downs.
Yeah.
So, but just to finish the point on the bust, we have 320 some odd trillion in global debt.
Yep.
A lot of it, granted, a lot of it is sovereign debt.
Mm-hmm.
And we have printing presses for that sovereign debt. So I'm not calling for, I think this cycle sovereign debt is probably pretty safe. But we also have quadrillions, and we also have a lot of private debt, and we have quadrillions in notional value of derivatives. And as I say, debt is a leverage on the economic system, the financial system. Derivatives are the leverage on the markets. When you've got leverage to a degree we've never had in history, it's so far beyond what it was even in 2008. You have to be nervous, because nobody knows, nobody has a handle. When you talk trillions, and then you talk 320 trillion for debt, and when you talk quadrillions for notional value of derivatives, there's not a person on earth that knows what that means, other than that's a lot, right? I mean, we don't have anybody that has a handle on what can happen with that kind of leverage in the system. And very simply, my view is, if you were going to have a plain ordinary, decently bad recession, you add on this kind of leverage, and it turns a plain vanilla recession into something far worse. So it's the leverage that is the big issue that will make the magnitude of this so much bigger than normal. And the fact that the leverage this time around is so much bigger than 2008-9, even though a lot of it is sovereign debt, a lot of it is also what can happen to the markets in terms of what the derivatives can do when they blow up. So, I don't have any specifics to tie that down to, but that's kind of the basis for my feeling that when this finally turns down, it's not going to be a plain ordinary downturn.
It's going to be ugly.
It's going to be ugly. And then you add to that the fact that we had the pandemic, 5 years ago.
Huh.
That it's hard to believe it's that long ago, but 5 years ago, and we shut the entire world economy down for a quarter. Right, we closed everything down because we didn't know what was coming or going, and then we dug ourselves out by printing a lot of money.
Mm.
Um, to me, that's what I call fragility in the system. We have, on the surface, statistically, we have recovered nicely. We look pretty good. Underneath the surface, you've got a lot of fragility. A lot of small, at least in this country, a lot of small businesses that are struggling because the world has changed since the pandemic. They have trouble getting help. They have trouble. Costs have gone up. We had the supply chain issues. We've had inflation since then. There's a lot of things under the surface that basically mean that you can't just look at quarterly GDP or data points that come out and say everything's fine, because there's I keep using this term in this country. There's a have and have not economy.
Mm-hmm.
We got a lot of people at the top that wealth has gone up both in home values and in their stock portfolios, their investments. But at the same time, you've got half the population that's living hand to mouth, barely getting by. And so we've got probably more inequity than we've ever had. And it's not just at the bottom 10%. It's really probably the bottom 50% is struggling to get by. So they don't have any room for error. If the economy turns down, you're going to see a lot of things happen, I think, that may not have happened in previous cycles. And so I always say the banks in the U.S., because of what they went through in 2008 and the regulatory requirements that were put on them after 2008 in terms of their capital requirements, et cetera, they're in better shape going into this one. So they're not where I point the finger so much. But I think Europe, certainly the banks are not in great shape. You guys have your real estate up on stilts, so I'm not sure your banks have a handle on their risk.
I think the challenge there, and I'll call you on this one, David, is that, and in Australia, the challenge we have, and why I think that real estate potentially is not going to crash potentially in this scenario, is that, quite frankly, we have not got enough homes for the population. You have to remember that in the last 2 years, we've had a couple of million people in immigration coming to Australia, and the housing has not kept up. So I actually see for the next few years that the real estate market here, regardless of what happens, I know it's on stilts, but it's a supply-demand curvature that's the challenge here, that they just cannot keep up.
We have some of that same thought process here. Mm-hmm. We're short, I think they figure a couple million houses maybe. My argument on that is what we've seen in previous cycles, and we also have, because rates have risen, there's been no, and a big chunk of the baby boomers have paid off their houses, so there's no real incentive for them to sell. They're just kind of sitting on it right now, even though the prices are up. Because a lot of people that would be the buyers can't afford the mortgage rates today.
Right.
So what I think you will see is, as you go through a downturn, a lot of that lack of supply turns into excess supply, because people do start saying, "Whoa, I missed it. I need to sell now. I should have sold a year ago, but now I have to sell." Or now I'm reaching a point where I want to go into assisted living, and I should have sold before, but I can't wait. So I think you're going to see that a lot of the lack of supply is a result of people's decision making, not a lack of housing. So in other words, it always happens in the downturns. We always hear going into at the top of the cycle that there's a shortage of housing, so prices can only go up. And then all of a sudden, magically, when things turn down, there's a glut of supply. So I would not necessarily count that. Now I don't know Australia very well, so don't count on me for that. But it does sound familiar to what I see here.
Okay.
And I don't know your banks that well, but I assume their loans are populated with high value real estate. So they're lending to high values, and if those values turn down, the banks can get in trouble. So,
Okay.
and Asia, we know Asia's running into real problems with their real estate, and obviously China, um, with what's going on there in real estate. So I think the Asian banks.
Yeah, sorry, with China, do you see China being able to manage their way through this, or given it's a slightly different economy, it's a big economy, it's 1.x billion people, run by Xi Jinping and the team around him, if you like, but is that can they manage their way through this unlike us?
I think that's the $1 million question. It's they what I have said before is that the so-called Chinese miracle, where they just were growing like a weed for decades, when you, and particularly since 2008-9, when you step back and look, so much of their growth was massive borrowing and printing of money. It wasn't so much a miracle. They were more, they were using debt more than anybody. So I worry now that things are going the other way. And they seemingly right now anyway are, even though they're starting to pick up the pace in terms of their stimulus, they seem to be trying to walk a line because maybe they didn't feel they had the flexibility they've had in the past to just go out and print money. And as you know, their real estate in that country, an awful lot of people were using the real estate investment as their savings. And now they got this massive glut, and they're plowing property, big apartment buildings, condos under, and individuals have lost a lot of money in real estate or are underwater big time. So they've got their hands full. I just don't know how it's going to turn out. They've got some flexibility because they are a more closed economy and they've got a lot of people, but I would not be as optimistic that they're going to come out of this one just like they have in the past. And particularly if we get a global bust, I'll use the same kind of thought process I used for what I said before about the U.S. If we're that leveraged and they're that leveraged, the jury's out in terms of what that leverage does on the downside. What I know is leverage enhances on the upside. It really destroys you on the downside. So,
absolutely. Yeah.